Last week, we saw one of the largest volatility numbers ever recorded. This week, we've seen markets rally to exactly where we thought they would, and it's all happening ahead of the big number. Inflation reports are coming, guys, and we need to talk about so many markets around the world right now. They're all hitting the key levels, and they're doing it with options flow, dark pool liquidity, and of course, CTA movement. So in today's video, join us as we cover off on whether volatility can spike once again and what to expect next for markets, whether you're an investor or trader. Stocks, commodities, and cryptos, let's get into it right now. Well, welcome back everyone to the Daily Show where we talk about markets around the world together, including the macro, the lead indicators, and of course the hottest charts. My name's Tom, and if you love everything to do with markets, remember to subscribe. But let's get into the first story. As you would have seen with the first two screeners here, it was a sea of green in markets coming off that pretty decent PPI number into the CPI, and it sent the markets exactly where we expect them to go, the 5400 to 5440 area on the S&P. And what was it led by? Well, technology stocks. Nvidia in particular has been doing very, very well. And that's exactly what we were thinking last week when we saw that crash. This market looks like it's ready for a bounce. And what's going to lead us up? Well, of course, the stocks with the elastic demand. Nvidia being the best in the world, and it's found a pretty good footing, well over 20% up at the time of this recording since those lows. But let's talk about volatility. Could we see another resurgence of volatility? And what does volatility actually mean for markets going forward? So this is a great chart here, and it's a very interesting point. When we see spikes in vol, it often means a slowing economy. But like any data point, it's important to put it together with quite a lot of information. I think this chart is absolutely amazing here from Todd Son. Not enough views on it realistically. And what it is it's showing you volatility ranges over a period of time. So right now, S&P 500 annual performance versus days of trading range over 1%, you'll notice that we're sitting at around 33 to 35% of over 1% trade days. Now, this is important because it's the number of historical movements. If we have 50% plus of days being very, very volatile, you're generally in a bearish style market, sometimes with really poor returns, particularly, of course, back here in 2022, 2002, 2000, 2001, and the global financial crisis, we were having massive volatility over that period of time, and it leads to further bearish action. When we've seen only around 33% though of pretty volatile days, that actually comes with some pretty good gains. On average, we're seeing usually between 10 and even upwards of 30% annualized performance off these particular reports. So sometimes high volatility can bring with it some pretty bad performance, especially if it comes with other cyclical factors. And you'll notice that some of these points are good and some are bad. And I would notice that a lot of these are either late cycle, that is, we're getting close to the end of a run where volatility and FOMO starts to take over, and the fragility of the market takes over, which is something we're starting to see, or it's coming out of a recession similar to these other two periods, 2003 and 2009. So a great chart to keep here. And of course, volatility is the number one thing that most people are talking about right now, along with rate cuts on the horizon. We've got some data and stats on that very, very soon as well, which I think will interest you. Let's go through the solid S&P 500 returns after a really high single VIX spike. So, of course, when we take this into consideration, we know around 33% of the year has been a little bit volatile. The rest has been not so volatile. We can kind of start to put together the pieces of the puzzle. We can start to look more at these 97, 98 runs, possibility of 2018 runs in recorded history, and maybe even the 211, 215. These types of markets synergize a little bit better with what we're actually currently seeing in terms of market structure and market similarities. So when we overlay them all, as you may have seen in our previous video, we talked about the 1960s concentrated run. We've talked a lot about the 1990s concentrated run. And more importantly, everyone's ignoring the so-called soft landing of 18, 19 rate cuts, which obviously ended up in a recession. And that's actually where we think we're probably being at. So what does this mean? Well, it means that we need to be paying attention to the next couple of weeks. It's particularly the next 8 weeks going to be the most important. Wayne Whaley's got some great data that suggests that there could be a dipping point, maybe even after still more further rips, maybe back of September into October. And we'll talk about that soon. But when we look at this VIX, especially when we look at it considered overall, this is actually the number one read of the most wild 4-day switch VIX that we've had pretty much ever. So this is the start VIX at 38.57. Remember, it actually went to 65 at one point there pre-market. Ends at 20.37, ending a 4-day percentage change of negative 47.2%. Again, it was worse than that. And in these types of very volatile periods of switch, they tend to be flash crashes. Some notable ones here were again 2018, which is a very interesting point here. The markets did end up recovering, though we went into late cycle around this time. So important to factor in here, coming in on that T-minus 2 years, maybe even 1 year before something really happened. And we've also seen similar runs later on in 18 and of course back in the mid 2013-14 kind of periods. So we've had a lot of this into slowdowns. A lot of the time the 5-year averages look amazing. Obviously all markets look pretty good over a 5-year period. But I think the important factor is here, there are some green, there are some reds. Overall, there are more greens, and the 6-month averages are quite positive towards the market. The next 12 months are again all positive across the board whenever we've seen this kind of vol. Now, we have got some reports coming out as well from different places. Now, this one here is from Goldman Sachs, and it's saying between the months of August now to September, we're in buyback season. This is the second best of the year in terms of buyback seasons. And if you know anything about how markets have been realistically going up over time, a huge component of why the S&P 500 has done so well has been the buybacks. The buybacks have driven like a huge amount of the growth, of course, in stock markets. And this is realistically fake growth, but it has been now. So we know that over the month of August into September, there could be a bullish catalyst. Why? Because these guys are going to be purchasing. We currently estimate 90% of the S&P 500 is in the open window and closed again on September 6th, an interesting date. Corporates will likely take advantage of this dip with a $4.75 billion worth of daily purchasing power until the closed window. Take this into consideration, along with all of the corrupt stuff that we see that obviously is pushing these markets up. Plus, we see just in general purchasing coming in, maybe even from CTAs, which are underperforming at the moment. We'll look through that in a moment. And basically, we have a potential catalyst here to again push this market through August into September. Also, some other Goldman Sachs overall strategists are starting to throw in the towel a little bit here. Scott Rubner actually saying they are making their last bearish equity call for August. We are ending the worst of the equity supply-demand mismatch for August, and this is the inning 8 of 9 correction in the baseball game terms. So again, he's saying it's kind of late cycle as well, although he is so bearish, according to this, the global macro environment, I am turning tactically bullish equities on August 30th. Well, that's a weird type of narrative there. But anyway, some interesting reports here coming through. What we believe in this channel and what we've been talking about a lot is, of course, we're looking for those really key internal signs in the market that something is wrong. Do we have a really weak sector? No, not right now. Do we have over leverage? I've got some indicators I used for that myself. And I'm telling you right now, we don't have those over leverage indicators the way that I would usually see them into a monstrous debt crisis. So, of course, we are paying attention. We know that utilities have started to outperform versus the SPY this year, which is again a sign of late cycle investing. Gold is our favorite asset class at the moment. Again, not something I would usually take into a very good growth period in time. Gold historically underperforms. Just look at the last lost decade of it. So there are very, very good signs that we are pretty late here. Here's a great report. This one's coming from Sonu, I think, over on X, and he's gone through the PPI, obviously shared some data. You can see here the FactSet research systems showing that PPI coming in pretty nicely. It was basically flatlining and zero, so that is not a bad report. And overall, what it's showing us is that inflation could be under control. And I say could be because, of course, if we do see rate cuts, there is that chance that we get that Volcker problem, where basically what happens is we get the secondary uptick in reinflation due to it actually not being under control. CPI less than 24 hours, we're going to find out some more about that. And of course, everyone's coming out with their expectations. You'll notice here, the median forecast is 3% for the headline CPI, and the core CPI is around 3.2%. So it's expected to be basically in line, a little bit reduced here. And most people seem to be on the exact same calls. Now, do remember there is usually a JP Morgan game plan. I haven't got a copy of that just yet, but if I do get it, I'll try to share it over on X. So follow us in the links in the description down below. July CPI forecasts, again, further ones here. Again, you'll see they're all very close together. And this just shows you the 0.2% and 0.19% expectation. So if we come in anywhere around that, remember the market will decide what it wants to do here based on structure. And if it wants to liquidity trap, it's going to do so. We're at that key level on the S&P, which we'll look at in a moment. And that is just the most key point. You know, we're at that point right into a big piece of news. This news allows liquidity to come into the markets. It allows huge amounts of movements. And of course, it allows for traps to be set. This is an interesting CTA chart here. It's US systematic positioning versus the S&P. And you'll notice it's a little bit different to normal. It's CTAs plus risk parity plus vol control funds versus the S&P. And do you notice or do you spot the kind of interesting factor here? If you spotted the fact that CTAs are positioned underneath the market action itself, because remember, this is delayed, that's another reason why these markets, of course, have had to uptick. Whenever we've been kind of at this point where CTAs have been hugely underneath their own market, it usually has rebounded. And this is quite rare. It doesn't happen that often. But we suspected this was the way. Once they freaked out last week, especially on the way they were flash crashing, it was a good chance that it was going to bounce. And of course, we've seen that, and we'll bring up our latest CTA reads in just a few moments. There's another interesting one here, which is Nvidia versus the stock market. So basically, if we take a look at the forward guidance here in terms of forward PE, we kind of overlay it versus the S&P. Nvidia is not as expensive as it was. Now, we all know that because, of course, it dropped off, 38%. And so since then, it's put on some good numbers. But it's actually trading at an okay forward multiple. I'll bring up on the next video where we're actually trading on a 5-year average so you guys can see. This earnings is still to come, and we know this market, it's all about Nvidia, it's all about AI bubbles and all those types of things, and that stock has to present good numbers. So we will be looking for that. Now, I'll put this back in there. Of course, we expect a rate cut. We know that there's a good chance a rate cut will come in September. The speed at which the Federal Reserve rate cuts will tell us a lot about how scared they are of the market. 50 basis points, not good. 25 basis points, more in line. We usually fall off before this kind of rate cuts. So in general, everything's in online really here for either or, no recession or recession over the next 12 months. And the next 2 months afterwards to 3 months after the rate cut happens, that's when we'll really figure out whether this market is super sick or not. Another one here is that bonds are expecting these rate cuts again. So everyone in the market, bond traders, everybody else is expecting that short-term rates are going to make moves. So of course, the September rate cut is all but fixed into this market at this point. If it doesn't happen, that would be wild in itself. As we know, 50 basis points of the last 5 rate cuts, when we've had that, bad times ahead. If we've had a 25 basis point cut, bad times are still ahead. It's just a little bit further off. So, generally speaking, the data doesn't lie. 25 basis point cuts, both of these were late cycles. Both of these were lauded as soft landings. We've fixed it. It's all good. And then it wasn't so good. So, of course, we need to be on those outlooks. Doesn't mean we have to be scared and, stop investing or anything like that. But it does mean you need to be more considered, I guess, with your leverage in particular. Because, of course, you don't want to get left holding the bag. And in a video soon, we'll talk about the lost decade that we believe is a real problem for indices. I'm interested to know in the comments down below, do you think that the S&P 500, if we see, let's say, Nvidia go to a new all-time high, if we see the tech sector go to like 38% of the market, are we heading for another lost decade? It's not unheard of in the US markets. It's happened before. And of course, it has happened in many markets over the last 15 years. Gold, European markets, and of course, Australia as well, suffering a lost decade, the country that I'm in. Now let's move over here. This is, of course, in terms of stock market action. S&P 500 performance after a great start to the year, January, July, 10%. This is Wayne Whaley's data. You'll notice that it has a couple of interesting factors. The first one is that we often do run, it seems, through the August, September kind of period. You'll notice here, things going to get okay over this time. But there is a correlation with the first 2 weeks of August being bad and a September late to October kind of early run down in the markets, like a dipping effect. That doesn't mean we're going to a new low. Of course, that may not be what happens here. but a dipping effect statistically would be on the horizon. It kind of follows some of the other data stats that we've seen so far. Wednesday is still big for earnings, guys. UBS, Tencent, the one we're looking at the most. Alibaba on Thursday, JD as well, Walmart, and plenty of other companies coming out. And these are some of the expected moves based on the options market. So definitely look at this. And just to give you a quick overview of earnings season so far this year, it's pretty good. Earnings overall revision is up. That is, of course, a positive thing for markets. And we're all bombarded with negative news, but in general, this is not that bad. This is kind of good. So at the moment, revisions are up, and that's a good sign. And of course, that feeds into our Whaley breadth thrust data, which generally suggests we could have had a little bit of weakness here for the next couple of months, particularly the next 2 to 3 weeks, which we did. And then we hopefully are going into a bullish run to get that last kind of big area on the markets. Interesting one here. This is something we talked about in our private community. Links in the description down below if you want to join us for a free 7-day trial. And we talked about Starbucks. Now, we were seeing a lot of dark pool liquidity. I looked for more dark pool liquidity over the last 24 hours. The only notable one I saw was Nvidia, which came back into the line. We'll show you on the chart soon. And basically, it's hit an area where we've seen previous dark pool, and there was a big one near the close. So there has been a little bit of trade on Nvidia right into the CPI. I'd say someone took profit over the last 24 hours, but this was interesting. Starbucks was building position. Large trades were coming through. And then, of course, we saw a monster CEO change, and this is leading into a huge, I think the best day for Starbucks ever recorded. That's how big that was. And Chipotle was down, and Starbucks was up big time. So, yeah, it's a huge move there, and I'm going to guess there were some loose lips because there were some large trades going in on the bottom just a few weeks ago on Starbucks. Let's move over here to what's been going on in terms of the market sector rotation. And we've seen risk on over the last 24 hours. Clean energy, solar, unusual to see those up recently. Semiconductors and tech and consumer discretionary leading. And of course, you know, the usual suspects that we like. Gold, banks doing okay, most things up. The only one that was down was energy for the market sectors. Semiconductors are now the best 5-day return with 8+%. And it's a little bit clipped here, but in general, you can see gold, semis, some of the things we've liked recently doing quite nicely. Now let's move over to the S&P 500 because it did it. It moved up and it did exactly what we suspected it would do. On the futures right now, it's trading at 54.40. This is exactly the zone we hoped it would get to before CPI. Why? Because it's the key zone. We know that a 5,600 plus break close is incredibly bullish towards basically all-time highs and continuation of a big bull trend. We also know that this level interjects with so many different things. Now, I've updated a couple of things here for us. We've got the 1-day expected options moves updated so that we know where those are. We also know that we have a 61.8 fib here. We have a downward trend line. We have the trend line of the previous lows that were supported, and everything is intersecting around this zone. Now, of course, the most important thing is, do we have options call walls around this area as well? Well, as it turns out, we do. There are huge amounts of calls floating all over here, and we're now back into a positive gamma situation. So, of course, if this CPI number is favorable, the market could go ballistic, but this is also where a bear might be hiding. So let's have a look at a smaller time frame. We'll go 15 minutes together, and we'll look at how this market traded. It traded up, and now it's kind of flatlining into the CPI. Now, as I often say, when it comes to news, if you're a day trader anyway, it's better to have patience and to look. Now, you say react is a bad idea, but reaction of liquidity grabbing, the reaction of stealing from us, the retail traders, and stealing from our psychology is often what you look for. So in this case, what we're looking is maybe an early spike of the market. By the time the market opens, maybe it rebounds back down. I'd like to see it coiling all day here coming into the US market would be good. And a coil, then an up, then a down. That could open up a day trade towards the short. This is, of course, where bears are going to be sitting if they're taking profit, or bulls are taking profit and bears want to get in. If you are bullish, which you probably should be in general for the market right now, you are looking for this thing to smash through a 5,500 and begin a serious squeeze, because there will be a lot of people that will have stops above this point here. And if the market's able to take those, again, there could be some bearishness around here, but these are the last bearish areas for this market. Let's have a look at the actual options so you get a bit of an idea of how stacked this is now. This is, of course, OPEX week, but on top of this, look at all of these calls, guys. Wow, they're everywhere. 54.40 to 54 kind of 80, 5500, it's stacked with calls over the next 24 hours. Now, the market would be probably not wanting to pay those out. Remember, generally speaking, retail and hedge funds and stuff, they buy a lot of these, whereas, of course, market makers sell to us. So they may not have hedged those positions off. Therefore, if the market does go ballistic, that's why you get that positive gamma kind of event. But this is still a resistance. So we are at key resistance not only on the TA charts, but we're also on the key resistance when it comes to the options walls. And we know between 54.40 and kind of 5500, there are a lot of calls floating around there. And it goes through into the next session as well. If we goes through into the Thursday session. So these options, there are a lot sitting here when it comes to the 14th and the 15th. And of course, we're paying attention to whether these can hold as a resistance on these markets. If they get taken out, well, you know, it will probably create a bit more of a squeeze event. Now let's move over to CTAs and what they've been doing. So we saw them spike up, they've dropped back down a little bit. Same thing, of course, on the S&P. And you would have had to expect, because this is a little bit delayed in terms of the data we get from these, that they'll be picking it back up. You can see here what happened with the market rallying. And again, CTAs could be caught underinvested here. So if markets do push to the higher 5600s, then there's a good chance that we could continue to rally because CTAs will start to buy back in. The momentum funds are actually down on the year now, or not performing well at all. So again, they could be starting to pick back up. Copper CTAs starting to buy the dip, which we suspected, and copper's still holding a very good structure that we looked at in the last 24 hours. Brent CTAs picking up the dip, which we suspected. Silver CTAs buying the dip, which we again thought so. And again, gold looking quite good on the CTA landscape. So all of those things we've been talking about now for a couple of sessions, they're all coming true in terms of they're getting picked up by the CTAs and market structure has come along with them so far. Let's move over to Nvidia. What a day it was. 117 smacked in. Perfect level for us to get to ahead of CPI. We are now once again in a positive gamma situation. Again, this pushes that narrative that if CPI comes in cool and the market loves it, that it could get quite ballistic out there in markets with all of this stuff. We do need to be careful about 117, 120 because 120 is a massive call wall and this can stop the markets. But in this case, of course, the catalysts are in the side of the bullish side right now. Even though we're at res, we knew this already. We pulled up to this level. I would suspect that people have been taking profit as of the close into CPI over the last 24 hours, but still a very good level. Now we find ourselves Tesla above 200, sitting at 208, which just so happens to be exactly where we've got all these calls. Not 210, they're at 208 now. And again, moving into a positive gamma situation. So another stock that could be pushing towards 220 and another stock that's looking quite good in terms of options flow as we speak. Let's move into the leading indicators. S&P 500, central banks, both showing the purple line here, world central banks, and green line here, both neutral, slightly positive across the board over last week. The volatility index dropped underneath 20 and closed. Again, that is more of a neutral bull market. And it spiked up and it dropped so quickly. But do remember, there is usually, whenever we see these big spikes, a secondary spike somewhere around afterwards. So when you see a big spike, there's usually a secondary spike a couple of months after, within that next 1 to 2 month period. And that would line up pretty well with running through August, running through to September, and then seeing weakness at the back end of September. So the VIX is probably not done yet. And if we keep seeing hugely volatile days of over 1%, that starts to stack up cumulatively. Well, we know that that brings in the possibility of a fragile market and, more importantly, a weakness in the economy. So remember, the markets aren't stupid. They tend to do all these things to trap people in. What about the US 2-year? Dropped off after the PPI result. We'll be watching that over the next 24 hours. Treasuries have started bulling back up. We really liked that pullback zone last week for longer term holders. Not a big fan on trading treasuries. I think they are something that you would hold for usually 6, 12, 18 months plus. Let's move over to copper. Great structure, continues to find bulls. This is exactly what we want to see. And so far, so good. Let's have a quick look at the daily close. Again, rejecting off the lows there and finding buyers. So we're looking at copper kind of strengthening, looking at least to 4.15. And of course, I want it to 4.24-ish zone. Dollar index weakened, which is not unusual. We thought it might get here before weakening. Yeah, Dollar, it doesn't look good. Doesn't look good at all. Doesn't look good in the weekly. We'll do a special on it post CPI this week. Gold looks good. Looks really good. Nice series of high lows in this case, not high highs. We're looking for the 2480 plus closure out to really get a possibility of a run to 2600. And again, it's been doing a nice accumulation for quite some time. Weekly looks good. Daily looks good. And it looks good across the board. Silver gold ratio still holding very, very low, which brings us to silver, which is doing quite nicely. Now, a few of you in the comment section said, silver sucks, man. Yeah, of course. It's sucked for a decade. It's been terrible. But there are times to own certain things and times not to own certain things. Now, you might say, well, everything's terrible for silver right now. There's a reason it's dropped off. Remember, silver has actually dropped from its top back here in May, because it actually hasn't been topped since May. It actually dropped 18.44%. So silver is down quite substantially. It's been underperforming gold. It's not the greatest of the precious metals, but the structure is telling us. And remember, on this channel, we always go with this kind of flow concept. Number one, TA. Number two, we look at the data. And of course, we look at the flows. And number three, we look at the cyclical theory. Now, if you ever want to find out more about the cyclical theory and importantly, the data and the TA, of course, check out our courses over on fxevolution.com. Cyclical theory is now advanced course. And it will absolutely, I'm telling you, it'll blow your mind. It'll be just so wild because what really is going on here specifically about our calls on gold, there's actually a lot more to it. And we've shared some of our main thoughts, but of course there are more to that. And this system is built on, of course, debt. And once you start to understand those systems and you understand that we do and make the same mistakes, you'll see what I'm talking about. Either way, silver has started to improve on the structure. And of course, again, it rejected off that little switch zone down there, finding buyers. Like to see a new high over the next 24 hours. Let's see what the CPI can do to us. Can we get back above the daily 20 moving average, etc. Let's move over to oil. Oil is holding well. I'd like to see it pull back a little bit more, maybe to 77 a barrel. Now, oil is an interesting one because yields, and especially if they start dropping off like the cliff, you will not usually want to be an oil bull. So yeah, we'll have to see how this trades. At the moment, the price action is looking bullish. So of course we go with that from the day trade perspective. And we're looking towards 82.50 a barrel now that it's done our first initial projection of last week. And that was a great trade. I'd like to see it continue to strengthen for now. Let's move over to Tesla. 203 got broken in the morning and it went up and it closed quite nicely. It opens the idea of the 20 moving average getting hit and 220 being the next area that Tesla should move towards. CPI might stuff that, but at this stage it looks quite strong. Then we've got Nvidia, 117. We got so close to that right number. This is a phenomenal thing. I posted it over on X and I said, can we hit 117 today? Well, certainly we almost could, and that was a great point. Now, as I mentioned before, dark pool liquidity. Huge trade here, huge trade here, huge trade at the close. This area has been traded a lot by big traders. And initially, I guess it was a sell because they obviously dropped it down. We thought it might have been a buy because, of course, they were selling over here as well. But yeah, initially it looked like a potential buy. It might have been a sell. They've put in another one around this zone. So I would say somebody that bought the dip last week took some profit into the close there ahead of CPI. Doesn't mean you have to be terrified. Some good signs are that, of course, we're starting to break downward trend lines, etc. But yeah, this is the key point. And we'll need to breach and break through this level up here, probably that number, to really start this market rolling. The good news is that the market was recovering on Nvidia. And that's what you want to see. You might think, I don't want to see that. But if the AI stocks are going strong, that's a good sign. Semiconductors also starting to pick up. And a good way of tracking this is to look at Nvidia versus the SPY or semiconductors versus the SPY. If this combo is breaking out, and you can see here it started to break out to the upside, that's a trajectory of this market getting healthier again. You might notice inverse head and shoulders, left head, right shoulder, or left head, right shoulder here, and the break of the downward trend line. Again, this is a positive initial sign for the market finding base. And it's a good little kind of tip there. Look for the leaders, and if the leaders are leading once again, that's a good sign that risk is back on the market. And so far, so good for the recovery. Maybe a little blip here over the next 24 hours though. 700, 10 cent earnings is coming. Don't confuse it with 10 cent music. Let's see whether China stocks can get back involved. That's a good breach of the last 24 hours. No HSI breach yet. waiting for Tencent. I believe that could be a catalyst, or Barber or JD. US 30, Dow, it's boring. That's why we don't really include it too much. As we suspected, underperformer versus S&P and NASDAQ. So yeah, not that interesting. The one that's probably more interesting is the Russell 2000, because it hasn't had a run up yet. It's been trading around a beautiful accumulation. It's struggling with 2103. If it gets through 2103, it could start that resurgence that we saw, because remember, rate cuts are still on the horizon. All that freak out of the last couple of weeks. Okay, a lot of people probably got liquidated then. It came down into a perfect zone, a very great area for market bulls to be in, but we haven't seen that catalyst. So if this market starts to run up more, okay, yes, we need to see Nvidia lead, semiconductors lead, but at the same time, small caps should start to come around with it. So there are opportunities on the horizon, especially if the markets keep going bullish after the CPI read, etc. And the Russell could be the one. Qs moved up, filled the gap, very nice. 470 is kind of the res here, along with the daily moving average, which you'll notice is here on the Qs. And anywhere in this zone is where we're looking for that rejection, because of course we talked about this area. We've got anchored VWAPs, we've got trade zones, we've got the trend line from the bottom up being intersected. We also have, if you notice here, this one kind of just getting breached out. So there's a lot going on here for the Russell, for the S&P and the NASDAQ, and it all culminates into the CPI number. Again, small timeframes like we've done on the S&P before will be where we look for the action. Speaking of small timeframes, I thought it might be interesting to go back and revisit our Monday stream where we talked about, again, this level here, finding a buyer. Okay, it went lower, but it held that low, and so far it's defended that base and found some strength. This is a pretty good sign for Bitcoin. It's starting to put pressure back on that 62,000 zone. And as you know, that's that 61.8 retracement, similar to what we're facing here with the S&P. So again, the S&P could do this. That would be very strong for it. The S&P could, do that. That's much weaker, of course. But in this case, the Bitcoin market is looking quite a lot better. So is the Ethereum market. Ethereum playing catch up over the last 24 hours. And if it does breach through here, there's a good chance that it might go and do the magical 69K plus. And if it does that and it closes weekly wise, well, we might have to start talking about new all-time highs for Bitcoin, because that'll be a huge deal. So at the moment, pull back in time, looks like accumulation. Let's see what happens after the CPI. Ethereum, let's have a look at that one. Again, trying to press that high, trying to get some catch up. This is still well behind Bitcoin, which is normal. The rest of the crypto market's trying to catch up. Bitcoin leads, Ethereum comes second, or Solana at the moment, and then the rest comes through. So we know the dance and we know how to do that. But at this point, we're watching to see how the CPI is. Remember, it's patience. Let's react to it. Let's see what the market actually wants to do. Once the market shows you the flow, then hopefully we can see it. And the main thing here was that we reached what we thought we would over the last 24 hours. We managed to get to this very key zone. And that's a great point for people that were locking in a bit of profit next week that might be worried about the CPI number. What a fantastic zone. Congrats to everyone that did that. Core CPI, as we know, 0.2% is the expectation for both core and CPI numbers. Then we have retail sales coming out on Thursday, which could also move the market. We've got that earnings coming through, and there's so much more coming on the horizon. This year's election year, anything can happen in markets, and of course we'll need to be on top of it. But as you know, volatility, it's certainly a warning sign for market fragility, but as we've seen in previous stats and data, you really need over 50% of days tracking with high volatility to start to see that significant weakness in market structure. If you're interested in finding out more about what we do over here at FX Evolution, make sure to subscribe to the channel, follow us on X, check out anything else we've got in the links in the description down below, and have a great day. Congrats to everyone that's been purchasing over the last week or so. You've done very, very nicely. But remember, this doesn't happen every day. That's why you've got to be in it to win it. All right, catch you guys. Bye for now.